Don't focus on making money, focus on protecting what you have. Paul Tudor Jones. Rule number 1, never lose money. Rule number 2, never forget rule number 1, Warren Buffett. If you were to ask the 100 greatest traders of all time what the key to successful and profitable trading is, 100 of them would say it's one thing, and that is risk management. So in this video, we are going to break down what exactly is risk management, how I use it in my own personal strategy to get results that look like this, and how you can do the same. All I ask is for a quick like and subscribe if you enjoy the video, and let's waste no more time. Let's dive right into it. So what is risk management? You hear it all the time, and I know it sounds so boring. Risk management is not going to be the key to my trading, you say. But the issue is that you can't have a successful strategy without good risk management. And risk management, as boring as it may sound, was literally all it took for me to go from being a struggling trader to now a pretty consistent trader. I ignored it for many years, thinking that if I just got my strategy right, risk management would come later. But that is not the case. You need risk management first. So risk management is all about balancing three things, and it's very simple. How much are you risking on average per trade? How much are you winning on average per trade? And what is your average win rate? So this little table right here shows us the relationship between risk to reward and how often you need to win in order to actually make that strategy profitable, okay? So, of course, if we start in the middle here, we'll see that if you have a reward and risk of 1 each, you risk 1 to make $1, you need at least a 50% win rate to make any money, right? Just to break even, you need a 50% win rate. If you are risking $1 to make $2, well, now you only need to win 33% of the time, right? You only need to win 1 out of every 3 trades in order just to break even. Now, the opposite can also be true. You can have a high win rate strategy, but usually this involves a skewed risk to reward or an inverse risk to reward. So for example, you can have a high win rate of say 90%, but this usually means that you're risking more than you are making each trade. It's very hard to have a really high win rate and not have an inverse relationship between risk to reward. But in general, this chart right here basically tells you the math that you need to be aware of when you are taking a trade. On average, how much are you risking? On average, how much are you winning? And what is your win rate? How often are you winning? Now, the key to having a profitable strategy, from what I have found, is not focusing on this upper area here where you're risking more money than what you make on average and then having to basically have an insanely high win rate. The key is to have asymmetric risk to reward, to have a strategy that maybe doesn't have the highest win rate, but when you do win, you are winning a great deal more than what you are risking. And I'm going to get into the specific strategy that I use, and you'll see how this makes it a lot easier to trade. But in general, most great traders of all time, on average, you will see that they actually have a win rate of less than 50%. Usually, they're in this range, around 33 to 25%. Now, this is excluding break-even. So you'll see my stats. I have about a 61%, 65% win rate. But that is also because I have a lot of break-even trades. But if you can master the psychology and the discipline of winning less often, but making more when you do win, you will find that your trading will be completely different than what it is right now. It'll become a lot easier and a lot harder to blow up your accounts. Now let's get into the risk management blueprint that I've created for myself that you can steal today. It's the exact rules that I pretty much use in my own strategy that I have seen work time and time again. And it has been the complete game changer in my own trading. I can't emphasize that enough. Risk management, the most boring topic, is the game changer. So let's outline these rules and then I'll explain why these rules work. So on average, the rule of thumb is to risk 1 to 2% of your total balance per trade, okay? So if you take a trade on the NASDAQ and you have $1,000 in your account, on average, you're gonna wanna risk about $10 to $20 of your account per trade. So if you have 10 trades in a day, usually you're going to be aiming for a profit of around, let's say, $30 to $60. Now, this isn't counting the fact that, you don't need to trade with your own money. If you have a small amount of money, you can always go and use a prop firm to start trading bigger amounts of money. But on average, you want to risk about 1 to 2% of your total balance per trade. If you're just starting out, I would recommend risking no more than 0.5% of your balance when you're just starting out, because this will give you plenty of time to practice so that you don't go and blow your account. Now, here is something that I don't see a lot of people talk about, but it has also been the game changer in my own trading. Don't waste too much time back testing. Find a strategy that you like. Start trading that strategy immediately with real time and with real money or with a prop firm account. Again, risking super small. And the reason you're going to do this is because you are going to be finding when on average you are wrong, and that will become your new stop loss, okay? You are going to continuously refine your stop loss so that you know that your stop loss is in the best place when you know you are wrong in that trade. It's going to take you probably 10, 20, 30, maybe even 100 trades, but eventually you're going to find out exactly in whatever strategy you're trading when you are wrong, and that will be your stop loss. Now, if you are struggling with this, if you're getting stopped out just before the market moves in your favor, right? So you're not wrong, you're just too early. You're going to now start making your entry your stop loss. So you heard that right. Your stop loss is now going to be the point in which you enter your trades, and you're going to do this and test it out. And if you keep getting stopped out, you're going to keep rinsing and repeating this. You're going to take where you would place your stop and make it your entry. And if you keep getting stopped out, again, rinse and repeat. Look at your stop loss, take your stop loss, make it your entry, and eventually you're going to find that you're going to refine your strategy so much that you will find your ideal entry, okay? And once you have your ideal entry, and once you figure out where you are wrong, that is when you really start to develop a winning strategy. You need to repeat this process right here. These 2 bullet points are extremely important. Repeat this process over and over again until you find what works for you. Now, we're also going to use super small stop losses, 1 to 2 ATR, and I'm going to explain what ATR is. But keeping your stop losses small forces you to basically, 1, never blow your account, and 2, be able to repeat this process over and over again until you refine your strategy to where you have sniper entries, okay? So use small stop losses, 1 to 2 ATR. I'm going to show you how to do this. Go to break even once the trade proves itself. So basically, as soon as the trade shows that it's working out exactly how you would like it to, just go to a break even so you have no risk on the table. This immediately cuts your risk to 0 and again prevents you from blowing up. And do not take more than 2 trades at the same level. This will stop you from getting chopped around the same level of support or resistance or whatever you're trading. Because you are using small stop losses, it's very easy to get stopped out 3 to 4 to 5 times in a row. And then if you're getting stopped out this often, it really defeats the purpose of using a small stop loss in the first place. Now, before we get into the charts and the actual strategy and how this all comes together, we need to also understand the math of drawdown, okay? Now, in this chart, you're going to see that we have the percentage loss of trading capital versus the percentage gain to recover that loss. So basically, if you lose 10%, you don't need to make back 10% of your account. You now need to make back 11%. Now, I know you're confused, but let's keep doing this. If you lose 20% of your account, you now need to make 25% of it to recover that loss. You need to make 25% back. If you lose 50% of your account, you now need to make back 100% of your account in order to just break even. Okay, this is why it's so crucial that you don't lose big, okay? The number 1 sentence of the day is don't lose big. Don't lose big. So let's put this into practice. If you have $100 and you have a drawdown, basically you lose $50. If you lose $50, well, now how much money do you have left? You now have $50, which means that you now need to make back $50 in order to get back to your starting capital of $100. Well, in this scenario, you're losing 50% of your account. But in this scenario, you're doubling your account, or you're making 100% just to get back to break even. You need to double your account just to get back to break even. I want that to sink in. So the bigger the hole you dig yourself, the harder it will be to climb out of it. That's why you want to risk small amounts of money so that you never blow up, and use small stop losses so that you don't have runaway losses, okay? If you were to lose 90% of your account, you have to make 900% back, okay? I don't know about you, but there's no way in hell I'm making 900% on any account. It doesn't matter the size. So don't be egotistical and think that you can outsmart the market. If you're risking anything above 1 to 2% per trade, let's say, for example, 10% of your account per trade, you are inevitably going to reach one of these drawdowns and have to do this in order to get back to your break even. So just don't do it. That is the key. Protect what you have. Okay, so now you understand basically the relationship between risk to reward, how much you should risk per trade. But now let's talk about when you actually enter the trade, active management. So actively managing your risk once you are in a trade. So like I mentioned earlier in this video, and this is actually a screenshot directly from my previous video, which breaks down my entire strategy in depth. So if you haven't watched that video, you might want to go and watch that and then come back to this one. But we are going to use ATR for our stop loss. This is a great tool for having really good stop losses because it makes very good sense as to why it would work. But ATR stands for average true range. The average true range is basically, on average, how much is a candle going to move. So the range of any candle is going to be the difference between its high and its low. That is the range. And so this is what ATR looks like down here. And basically what it does is that it'll take the average range of the previous 7 to 14 candles and give you it as one number, right? So in this case, we have an average true range of 20 points. So that means on average, each candle on that time frame, in this example it was a 1 minute time frame, each 1 minute time frame candle is going to move 20 points in either direction, up or down. Okay, that's the average range. So I like to use a 1 ATR stop loss because, again, it forces me to have really good entries and really good risk management. And basically the way that I think about it is that if your strategy really is good and you have good entries, you shouldn't need a stop loss bigger than 1 average true range, okay? Because that just means that the market is going against you and that area that you marked out maybe is not as strong as you think. Okay, and then I go to a break even after we do +1 to 2 ATR. That just means that if we have a move of 20 points to the upside, I will go to a break even because that is 1 ATR in my favor, right? Now, something that I don't see a lot of people talk about, and it is really misunderstood, is the concept of dynamic risk, okay? This just means that your risk is constantly being adjusted, and this is part of the active management side of things. So for example, let's say we want to buy right here, okay? And we want to risk below the lows, and let's say we want to target these highs, okay? So we are risking below the lows, we're targeting above the highs. Most traders would say, okay, well, I have a 1-to-1 risk to reward, and that's it, right? So I'm going to need this strategy to win about 50% of the time or more for me to make money. But that is not how professional traders trade. Professional traders are constantly managing their risk during the trade, and you're about to see why, okay? Let's say we get this entry, right? Let's see, price hits our entry point, and now we go back up to these previous highs. Well, now, if I wanted to, if this was part of my strategy, and it should be, in my opinion, this is what I do, instead of risking below these lows, I can now move my stop loss up and actively manage my risk and make my risk smaller by either going to a break even or by setting my stop loss below these lows. Now, something really crazy happens here. As you can see, our risk to reward is no longer 1-to-1 now. Our risk to reward is 3.59 to 1. So almost a 4-to-1 risk to reward. And if we wanted to move it up even closer to those lows, you can see that theoretically this trade could be a 5-to-1 risk to reward trade, okay? Now, this is the thing that a lot of people don't understand, is that you don't need to have a 5-to-1 risk to reward ratio as soon as you enter a trade. You can have a max loss. Let's say our max loss is below these lows, but most of the time, if you have a good entry strategy, you're not going to reach your max loss because you are going to actively manage your stop loss and actively take risk off of the table as the position goes in your favor, okay? So even if you have a strategy that at first has a 1-to-1 risk to reward ratio, it does not mean that you are going to need a 50% win rate, because if you actively manage your positions and constantly make sure that you are decreasing your risk, on average, you are going to have a much bigger average win when you win than an average loss when you lose, right? Because you're not going to always hit those max losses. So technically, you can have a strategy that has a 1-to-1 risk to reward ratio, but completely kills it even with a win rate of less than 50%, okay? Let me say that one more time. You can technically have a strategy that has a risk to reward of 1-to-1 and have a win rate of less than 50% and still print money if you are actively managing your risk, okay? Because on average, your risk to reward is not actually going to be 1-to-1. It is going to be greater than 1-to-1 because you are constantly making sure that you are risking less than what you are targeting, okay? That is active risk management, and you're about to see an example of me doing this in real time. Okay, so here we have one of my live trading sessions, and I'm about to enter a long position. So you can see that my risk is about 18 points, and I just got filled there, and that is because that is 1 ATR in this session, okay? So 1 ATR is my stop loss, but that is not going to stay as my stop loss, because as this trade moves into my favor, I'm going to actively manage the position and start moving this stop loss much higher up so that my average risk is cut down by almost half. So let's see what happens. I'm going to fast forward a little bit here, 30 seconds. So now the trade is starting to go in my favor here, and now I want to get more aggressive with my stop loss because I don't want to give this thing any room to run. So as we see this big push up higher here, you can see that I move my stop loss up, and now my risk is pretty much half of what I started out with, okay? So just because my risk started at 18 points doesn't mean that it has to stay at 18 points. And eventually the goal is to get the stop loss to a break even. Now I don't think that happens in this trade. I actually think this might be a losing trade, but it is a great example of actively managing risk. So let's see what happens. I probably will move it to break even here, knowing me. Let's see. Yeah, this should go to break even. Yeah, and boom. Now I'm at a break even trade. So now I have absolutely zero risk. I moved my stop loss to my entry point, and now I have zero risk. And that's how you actively manage a trade, okay? I went from 18 points risk to now 0, and before that it was probably like 10 points or something, okay? So we went from 18 to 10 to 0. That is active management, and that is how you make sure that you always have bigger wins than losses. Okay, so now let's talk about another critical topic, the psychology of losing, because when you trade with good risk management, oftentimes you are not going to have crazy high win rates, okay? That's just how it works. You're going to be taking a lot of small losses a little bit more frequently, and I know you don't like hearing that, but I'm telling you, that is just the reality of trading. At least the way that I trade and how I see a lot of really successful traders trade, they are constantly taking small losses, but when they win very big, okay? So your job isn't to win, your job is to stay alive. Losing trades at break even is considered a win. When you're trading this way, you almost have no choice but to succeed. When you're constantly having a small stop loss, you will almost never blow up. It takes multiple losing trades in a row to blow up your account rather than one big trade, okay? One big losing trade. Instead, you're going to have a lot longer time in the market. You're going to stay alive. And because you have longer time in the market, you will have more time to refine that strategy. And when you're trading with that small stop loss and consistently adjusting your entry point so that's a little bit better each time, eventually you are going to be able to have pinpoint entries to where the price is either going to go in your direction or you're going to get a break even most of the time, okay? It's going to become very rare to get a full loss, okay? It is almost never going to just blow through your level and go to your stop loss. You're either going to get a win or a break even or a small loss. Most of the time, it is going to be break even or a small loss. But when you win, that win is going to get rid of all those small losses, right? If you lose 1, 1, 1, and win 5, okay, you are going to have a profit of 3, right? And so this makes the psychology of losing really easy because once you understand that you pretty much have a 0 chance of blowing up your account, that takes a lot of pressure off your shoulder, and it almost becomes fun taking losing trades because you just start to learn more and more about your strategy, okay? They're small losses, consider it tuition in order to perfect your strategy. As long as you survive and adjust, the profits will come. Trust me. So if you enjoyed this video, make sure to smash up that like button and subscribe if you want more videos just like this. Join our free Discord. Link is in the description down below. I'll see you guys in the next one. Peace.